And that brings us directly to our top line story. U.S. equity futures this morning have swung between gains and losses, hinting at another volatile session on Wall Street as the arrival of new U.S. trade tariffs looms over markets. Meanwhile, gold has extended its winning streak and is further into record high territory this morning. The confusion over whether U.S. President Donald Trump will take a lenient or harder tack on tariffs is making investors wary of making risky stock bets, reports Bloomberg News. We'll have extensive live coverage of the U.S. tariff announcement tomorrow morning, including analysis from reporters in Canada and the U.S. and analysis from special guests. That's all day long tomorrow on BNN Bloomberg. We will cover the U.S. tariff announcements in great detail tomorrow. In the meantime, let's bring in a leading U.S. equity strategist to talk about it further. Our featured guest this morning, Nadia Lovell, senior U.S. equity strategist, global wealth management at UBS in New York. First of all, Nadia, it's been a while since you've joined us. We're delighted to have you with us on the show today. Thanks for making some time. And let's begin with what you and your team believe is coming on tariffs. What's the most likely path forward here?
Paul, as we know, there's still a lot of known unknowns. And I think that what the market has been grappling with is the potential for a wide range of outcome. We'll learn more tomorrow on Liberation Day. But, we've heard a lot of numbers being thrown out there, whether it's, 10% universal, 20% universal, 25% on select products or countries, or something less, or 60% on China. But ultimately, we think that we'll probably end up in a place where the effective tariff rate is closer to 10%. Now, that's not to say that in the short term, we cannot see a spike in that effective tariff rates. We think that, initially we could see the effective tariff rate spike up to something in the mid to even high teens, dependent on how aggressive that opening salvo is on Wednesday. We do know that the tariff framework, the president is trying to, rejuggle the global trading system, as well as increase investments in the U.S. and potentially raise revenues for tax cuts later this year. And so sometimes all of that stuff is at odds. And I think that that's what's causing the uncertainty. But we do expect probably an initial aggressive stand, an escalate, and then probably an escalate to then de-escalate, and to ultimately get to a place of around 10%.
You think 10% tariffs will be the end point here in North America after negotiations with Mexico and with Canada. Is that correct?
No, I think that will be the globally effective tariff rate. We came into the year with the U.S. Global effective tariff rate at 2.5%. We are already close to 10%, Paul, just given what has already been announced year to date, including the incremental 20% on China. So what we're saying is that on North America, we don't expect any aggressively high tariff rates to stick on North America in terms of Canada and Mexico. We know that those rates that have already been announced year to date, most of it is insulated by the USMCA agreement and free trade, duty-free agreement. And so far, it seems like the conversations between the Trump administration and the two countries, Mexico and Canada, has been quite encouraging. So we think that even if something comes out that was aggressive on Wednesday, that a negotiation will be made and a deal could come in a matter of weeks. But, that's not necessarily the same case for countries like in Europe as well as China. We think that the stance will be more aggressive against those.
What is your view on how 10% tariffs would affect inflation and economic growth in the United States?
So far, we think that, economic growth, as we know, the U.S. has come into this period from a position of strength. I mean, economic growth has been sort of above trend the last several quarters, around 3% or so. Inflation had started to make progress and moderate back towards the 2% target, even though we remain above it. Now, temporarily, we're likely to see a spike in inflation. We could see inflation, get back up to 2.8, 3% sort of range, and then come down after that, because as you know, that will be a one-time hit to inflation. How it translates to growth, that still remains to be seen. But I think what we can say is that the U.S. consumer still remains strong, and that has to do with a pretty robust labor market that we've seen. Of course, all eyes will be on Friday in terms of payrolls and how those numbers are coming in. But we have an unemployment rate that is at 4.2%. It could trend a little bit higher, but we do think that, spending in the U.S. will continue, capital investments will continue despite this period of uncertainty, particularly as we get into the second half of the year. So So we think the U.S. economy can weather that close to 10% tariff rate once we have that certainty. Is that certainty, uncertainty that is causing a bit of a softening in the survey data at the moment?
That's Nadia Lovell, her take on where the tariff issue is going in the short and midterm.